Okay, Friday 29th of May. I'm recording some thoughts just as I drive. I'm going to keep either stopping and starting this video, or I'll just try and hit pause if I can. It's just one-handed. Not even one-handed. I'm balancing the phone on the dashboard. Um, so I'm putting a huge amount of effort in at the moment to creating a very streamlined method of data collection. Like a week ago, I sat down and I did a whole load of data collection into a method, but that became very quickly, by about trade 15 or 20, it became really complex and it was easy to make mistakes putting the data in. And then I came up with a second version and I went further to about trade 40, and then I think I made another modification and I got to trade 78. So I've got 78 trades, but out of that, there were a number of occasions where, and I didn't know how to collect this at the time, and I think that, and the idea of talking this through now is a way of me saying it out loud and listening to the words coming out as if I'm listening to this playing back. So I'm explaining to myself my thinking. That's basically what I'm doing. So there were several stages. Well, there's sort of several gates or stages of the system. So the first one is that I've introduced, which I didn't do in the first day. So the first data collection basically was just, is there a PD array on the 4-hour daily or 1 hour that price has reached, and is there a 15-minute fair value gap or 1 hour fair value gap inside it and trade it? So there was zero consideration of what the overall direction of the day was. There wasn't any consideration of the higher time frame direction or bias, whether it was a range or bullish or bearish. And I mean, some of the quality of I just looked at every single array that you could trade that made sense in that level of rawness of it, and the edge was profitable. Now, I may have missed one or two bits out. One or two may be profitable, one or two may not be. I just don't know. So I'm going to go back through it like as a third pass on that, but not because I think I've missed anything now. I think I've captured everything I needed to capture in terms of the that. But I'll go back through, and if there's anything else in there, I'm going to grab it. But so anyway, what I've introduced now is, for the second batch, I think I got up to trade 78 with, was like a higher time frame bias. Well, I was doing a bias. I was sort of saying daily bullish, 4-hour bullish or bearish, and I was just looking at the candle direction, getting a feel of what it was doing. But actually, it was just one long line of text, and then I appended onto the end of that what I felt the forecast direction would be. So which PDA was in control and which one could be the target. Because actually that's part of the plan here. I hadn't really done that with the first level of data collection, but you do have to do that. You have to get an idea of, is the daily in control, is the 4-hour in control, or albeit a weekly, in fact, something which I've been ignoring the weekly to a degree, because I felt, well, when you're on the 1-minute entry, what's the point? But actually, I think that the point is this. What I feel is that when price is at the weekly, then that could be more potential for daily chop. And when you get sort of daily chop, that is daily candles starting to get a bit bunched up, well, the impact of that is now you're in ranging conditions on the lower time frames, and even potentially just getting chopped around on the on like 1 hour or 4-hour swing highs, and you're in a kind of a range and you're just trying to chop out, you just get chopped around a bit. So I think that there's potentially some information there which I can find useful. Now, does it mean I'm going to filter out chop days? I don't think so. I don't know. I don't think so. I'm not sure, but it could be, more than anything, the idea of that concept of coming into a weekly level is, okay, well, if those represent the flatter periods, as in the equity curve goes choppy and it's not growing, then that's fine. I don't mind that. I don't mind pursuing through those chop periods and not stopping trading, but to continue trading. And then once the daily starts to get some direction away from a weekly level, wonderful. Now, do I want to think about monthly levels? No, I really don't, because it's just way too high. But I think weekly actually is important to have a look at. And I think in terms of monthly, I think if the weekly hits a level, then it could get choppy on the weekly. But I think on the daily, you're probably more likely to see movement on that, and that's why I'm thinking forget the monthly. So there we go. So that's a gate I've added. The first thing, which is to look at the part of the price action on the daily. So firstly, it's the daily and a weekly level, and what is that weekly level? And then secondly is what's the daily look like? What's the 4 hour? What's the 1 hour look like? Now, where I draw the line on the 1 hour and 4 hour boundary is when I'm looking at the chart and I see a 4 hour PDA that we can trade off, then I won't bother looking necessarily at the 1 hour, because now I'm looking at the 4 hour. And so that's the level that's important. That's my thinking. So maybe I won't include the data on the 1 hour, but I haven't been. But maybe I'll do that just as a matter of course, as the field is created now. So there's that. So we've got the new section, which is the sort of a top-down analysis to derive which PDA is in control and where it's going from and where it's going to forecast. I don't know if it's going to do that. So that's like gate 1. And that could be a range. It's not even a gate that gets passed or failed. It's simply, is it bullish, is it bearish, which is in control. And if it's a range, then it could just be sweeping one end and coming back to the other end, in which case range means it's just sweeping each side. And again, that's fine. In terms of whether it's bullish or bearish, if there's a trend on the 4 hour or 1 hour, and there's fair value gaps and fair value areas being created and respected, one either bullish or bearish, then that is a trend. And if it's just going up and down, then it's a range. It's simple as that, really. So there we go. Right, where did I get to? So I've talked about which PDA is in control, or PDA to PDA, at the level that I'm looking and interested in. So I want to be in that direction, really. And ultimately, I'm not trying to pick the direction of the weekly. The weekly is just going to give me an indication as if the daily is going to be choppy. What I'm interested in really is the daily in control, or is it the 4 hour? And those, I think, are the ones that would be the most interesting. That's my belief. So the next stage then is which is the driving PD array, and that kind of leads from that first gate. So now I've got PD arrays I'm looking at, which is in control. So and if I know what's in control, then is that the driver? Potentially. So if the driver is the daily, so the PDA array, let's say the daily is in control, but the 4 hour might be the PD array that I'm trading, and it would be ideal if that move from that 4 hour level is in direction of the daily control. Is it going to be that every time? I don't know. I'm just going to take every trade and record it, and we'll see if there's a pattern. So it does seem so far that there doesn't seem much correlation between the session highs and lows, and I wonder whether that, although I felt there was a pattern in there, it could simply be that they just happen to be swing highs and swing lows, and sometimes they're respected and sometimes they're not, and that's it. I'm going to still collect that data and look back and see whether eventually, over like at least 300 trades, there's some correlation. So there's the gate there. Then the next gate is the resistance gate. So we've got the driving PD array. The next thing is the resistance piece. So what resistance is there? Is it 50 minute or 1 hour? And one of the things is sometimes, well, the 15 minute or 1 hour PD array is miles away from the driving PD array. You know, is that valid? And I've just been taking everything. And for the data collection, I will take everything. I'll just put everything in there and just treat it all as one big piece, because the fields I'm collecting will be good to play with filters in terms of, well, I'll come to this now. So what I'm able to do is to create a measure of distance for every time there's a trade set up between the driving PD array and the resistance, and that will be measured in ATR. And the calculation of the ATR distance is all being done mathematically. I've got price data for the 1 hour and 15 minute and 5 minute charts. And then what I'm able to do is to count, well, I've created all of this through Claude. So the ATR values for every moment in time going back on the 5 minute and 15 minute to 2023 January, they're all calculated. So what Claude can do is, once I've pulled in the idea is I've collect all the data and I collect a distance in pips or points from the driving PD array to resistance. So whatever the edge of that the driver is to resistance, I measure it in pips using the measuring tool. It doesn't have to be scientifically accurate. If I'm 1 pip out, it doesn't matter, because I'm going to be collecting 300 of these, and so there'll be a pattern. I'll be as accurate as I can be, but I think that it'll be like 99.9% accurate in terms of what I collect. And then what Claude will do, when I paste in the data, my total data I've collected, it will verify that it understands everything. I'll get it to play back to me what I've typed in, and then it can give me the ATR value of that distance in pips. So I put the pip value in, it tells me what the ATR is based on that date and time, and it will go and look in the spreadsheet and pull that out, because I don't want to do that. That's going to be like a real consuming thing to do. Right, so carrying on from where I was, I think I talked about the additional gate at the front, which was really to look at the top down, get a bias, i.e. which PDA to which PDA on the higher time frame. Then I talked about the driving PD array, which could be a fair value gap, a fair value area, or a swing high or swing low. Really, whatever price reaches is this in any of those, and then I look at the time frame below to look for the resistance. So if it's a 1 hour swing high or low, it doesn't matter where it is. If it's there, when price reaches it, I look at the 15 minutes just to see whatever fair value gap is there. I need to see a fair value gap and a fair value area, or just a fair value gap is fine as well. But what I won't accept is a fair value area without a fair value gap, because the gap is a much easier thing to measure a rejection on. The fair value area can be quite subjective, and so the gap is the bit that's essential. That's for 1 hour or 15 minutes. And then if it's a 4 hour swing high that's reached, then I look at the 15 minute and 1 hour to see whether I've got a 15 minute leg or a 1 hour leg. If it's just a 15 minute leg moving into a 4 hour PD array, that's nice and easy. It's a 15 minute fair value gap and or fair value area. Or if it's a 1 hour leg, then there may be a 15 minute option to get in. I need to see what my rule of thumb is about a 2 hour to get to a 2 hour trade before reaching the 1 hour level. I've kind of bleeded that a little bit, which is sometimes I've looked at like a 2.8 and I've just taken that and I've recorded that as a detail. So in those cases where I do that, I think I need to just call that out in the free text, or I call it out under that section. No, it'll be free text. So there we go, there's that. So that's covering the driving arrays. So the other things I'm collecting is the time price reaches it. So on the resistance time frame, what time candle that's closed that reaches that's what's logged. And I'm already logging the time that the higher time frame PD array is created. So I can look back to say, well, is there any difference between, say, price reaching a 1 hour PD array and then forming the reversal in a session versus outside of a session? Again, it may just be like a 50-50 thing. It may just be nothing in it, as in no correlations at all, nothing of use. Then, which is good. So then the next thing is the resistance itself. There's the resistance itself, and with regard to the resistance, then aside from the fact of what the resistance is, I talked about that, and what I'm looking for. The new thing I'm doing now is I'm measuring the distance from the edge of the driving PD array to the edge of the resistance in pips, and then Claude will look at the spreadsheet that we've created or it's created, and it will just get me the ATR value in pips of what that distance is, and that will then be a unanimously standardized ATR value across any instrument. It won't matter the instrument, it won't matter the time frames. The pip value just gives me an ATR, and the ATR is what matters. So now there may be a different ATR value between 1 hour and 15 minutes, but I can't see it myself. To me, I think it's just simply a case of, typically there'll be a range of ATRs for the resistance, and it could simply also be that it makes no difference. The resistance can be further away, it can be close, and the ATR value in the end doesn't matter. What matters more is the PDA that's in control, and I think it will come down to that. I think if the PDA in control, if you're trading in that direction, you're going to get the move, and the ATR value, as in the distance measured in ATR from the driver to resistance, I think that'll be secondary, but we'll see. So that's that. Now the big thing, which I'm collecting a lot more data on now, and then I'm probably missing some bits, but this is the thing I've really spent a lot of time thinking about and really wanting to make useful, and that is the entry itself. Now the entry, I've got two entries, as in there's the very quick alternative entry, and that's just a name that's stuck, which is, I'm not going to explain it now because I already know it, but I've got the alternative entry, and then I've got the normal entry. And so some of the things, I came up with some really basic rules from my 27 trades worth of data that I took as being de facto, this is how it works. And that was, with the alt entry, if there's any kind of fair value gap, wait for the normal entry. And then if it's a normal entry, then just take that entry irrespective of the fair value gap. And because in that data, most of the time, the normal entry was triggered because price had retraced to a fair value gap inside the rejection and pushed higher. And that was fine for that 27 trades worth of data, but looking at this bigger data collection I've got, there's loads of trades that get whipped out. There's a good 50% of them at least, 30% at least, maybe 50% have a fair value gap inside the rejection or a breakaway gap inside the rejection that is present before the trade entry. And so what I'm collecting data on now is a number of those aspects, which is, firstly, is before entry and before either the alt or the nor, which is the shortened versions of these, is there a breakaway gap, or well, no, it won't be an and, it is, or is there a fair value gap inside the rejection? If one or the other exists inside the rejection before the trade, irrespective of whether I've collected the data on it, and what I'm doing is I'm just doing a very basic entry. I'm not waiting for a retracement to it, I'm just taking it. But for the alt entries, I'm just taking those. I think I need to check the rules. It might be with an alt that I've decided if it's a bag, then I'm taking it, and if it's not a bag, then I'm not taking it. I need to go back and look at that just to be sure, so that I've standardized the entry at least that I'm taking in the raw collection. But what I'm doing in the data collection is I'm collecting the outcomes of both of those if they both happen to appear. For example, if the alt triggers first and then retraces to a breakaway gap, then if it retraces to a breakaway gap and then goes, I'm capturing that. So even if the alt entry rule that I'm using currently is, if it's a breakaway gap, ignore it, which I'll have to check actually. I 100% need to check that to an older rule set. In fact, I think that's in my trade plan rules that I'm using to collect this data, which I'm still using those same rules, which is basically, they're basic. They're just literally, is there a driver, is there resistance, is there rejection, and is there one of those two entries? So I just need to refine in terms of what I have been doing, and I'll continue to do that. So the idea is then, and then if it's a normal entry or a NOR entry, and there is a fair value gap, price makes the NOR entry, and then I'm taking that trade where it closes back across the rejection, and then a good amount of times it retraces back into that fair value gap that was inside the rejection, that was created before the NOR entry, and then it goes. And so what I'm doing is I'm tracking all of these where not only was the direction correct, which is what I'm tracking, which is useful to know, but was there a re-entry? And this is a big one, because I don't know whether it's worth even doing these. REO had said in his videos, well, if it doesn't trigger and if he takes a loss, then he wants to take a step back and have a think. But I think there's more to it, in my view. I think that what we need is data to determine whether or not that is the plan of action to do. So it could be, well, no, you don't take a step back. If the higher time frame is bullish or bearish, and we know what, I say we know, we don't, but there's a sort of a PDA in control that is more likely to go to, like one's pushing to another one, then in those cases I think it's then I'll just take the re-entry in every case. If there's a re-entry off that and off what happens, I'll log it as a re-entry. What happens after that? Does it run to 3R? Does the BE2 rule get triggered? And what the outcome of that is? I'll capture all of that in free text. So that's something that can be pulled out. So I think, I've looked at a few, and yeah, you do get chopped out if you don't, for example, if you're trying to take the entry and there's a fair value gap. You can get chopped out of it. So it could be that, well, actually in those cases where there is a fair value gap, not a bag, you wait for a retracement. And what happens on the trades where it doesn't retrace and it keeps going? Well, then you don't end up taking those. But if you reduce or remove most of the losses and then miss out on a couple of wins, well, do the wins you miss out on compensate for the losses that you don't take? So that's stuff which will come out of the stats. And then the other thing was, with regard to that, there's the let me think now. There's the idea of the, so I'm tracking the fair value gap or bag inside. I'm tracking whether it's an alt or NOR entry. Quite often one will trigger and the other won't be there. Usually if the alt has triggered and fails, the normal entry will turn up, and if that will only mean that price has retraced to a breakaway gap after the alt entry and then has moved away. Now the third scenario with fair value gaps is this, that you can have a potential fair value gap forming at the time of entry. And so what I'm tracking here is there already a gap, a fair value gap or bag inside the rejection, and is there a potential one? And then the potential one is tracked as potential, and then so the outcome is the final conclusion. So as in what I'm tracking is it's potential dash FVG or potential dash BAG, and the idea is then, well, there is a potential fair value gap and it becomes a fair value gap, and then in the cases where it becomes a fair value gap, the further annotations or codes are RET, retraced, and then the final one is SL, does it hit the stop loss? So it could be that it becomes a fair value gap, it does retrace but it doesn't hit the stop loss, or it becomes a fair value gap, it retraces, so it could be POT dash FVG dash RET but no stop loss, so there's no dash SL at the end, and that just tells me, well, yeah, fair value, the potential became a fair value gap, it retraced but it didn't hit the stop loss, and then the outcome still of that needs to be tracked as, was there a re-entry possible? And that's what the re-entry idea is in the further data collection is, if a re-entry was possible, then what was that on? And the re-entry will only ever be a closed back beyond that line. There's no other combination for that. It's simply a closed back above or below it or above it or beyond it. And then I'm tracking the time that entry occurs. So it could be, for example, sometimes the trade fails, I go to the gym and at 10:20 in the morning it re-enters and it runs and it was in the direction of the trade, and all that tells me is, look, the bias was right, the direction was right, it doesn't matter if I wasn't there to trade it, it's just in the stats, but the logic is locked in. I know that the logic is there, and that's absolutely fine, because there'll be plenty of times where that re-entry, if it does turn into be a valid follow-up action, like if the first trade is a loss, then it turns into a valid follow-up action that can be followed and then used as a rule. And so that's something I will take very serious consideration over as a rule. is there a re-entry option? And if there is, do you take it? Now, backing against that, the re-entry idea is, if the re-entry is following what was a retracement to a fair value gap that was present already inside the rejection, then it could be, well, actually, the normal entry triggered, but there was a fair value gap, and there's a good chance they're going to retrace. So that re-entry is nothing more than a entry after the retracement has come back into the fair value gap and mitigated it. So to me, it's those serve a good purpose. I can use those to really determine how to really assess what the process is at the entry. So ultimately, is there a fair value gap present before entry? If there is, it could be that, well, then you just wait for the retracement and then the entry. So it doesn't matter if it's like now a third sting, call it the third sting, it doesn't matter, because now there's a valid reason for waiting and accepting that third sting. And it could be, maybe that's a different entry technique itself, in that, or we call it something else, I don't know. So that's very valid. And really, from there, I think that's the last piece, really. The rest of it is collection of data. Is it news? Is it whatever? But I think that's, for me, quite a big one. Or the two big ones are, which could eliminate, well, let's say the idea of the daily range and looking at the bias and what's going on. Sorry, the daily, as in, is it inside a weekly range, is, could it be that the chop that I'm experiencing is because the price is at a weekly level, and therefore do you just trade right through the chop and just accept it's going to be flat and you're going to take losses, but you're active each day? Yep, I think that could be it. That could be the way to do it. The alternative is that when price reaches a daily level, weekly level like that, maybe that's a pause. Maybe at that point you put the blocks on and you wait now for some sort of pattern on the daily or on the 4 hour that gives you some confidence that things are starting to move in a direction, in which case that's possibly where you start trading again. So again, I don't know, that's something which I haven't thought about. It's just come to my mind now, and what I'll do is I'll upload this entire video, I'll get the transcript for it, and I'll get Claude to go through it and pick out anything from it that I've talked about that we're not including in this, because that could be a free text thing, as in something to look back at. Maybe not even free text. I think that's almost something to look back at. Is there a pattern? Yes, I'll tell you how I can look back at that. Is when did the equity curve start to grow again? And then that will be clearly where things are moving and have a direction, and then I can go back and look at that trade. Yes. That's a way of doing it. I can go back and look at the trade and see which trade that was that kind of started the equity curve rising again. Where did growth resume? That's a good one. And then the other one it came to last night, which I only thought about last night, but I'm too tired to do anything about this. But this is really, really, really something I want to be able to do. And this is a very visual way of overlaying the win and loss rate to candlesticks on the daily. And this is part of the hypothesis about, is it possible that when the daily is at a weekly level, that's where the chop starts? And so this is my idea, is I use Claude to draw me in a document. What the heck is this van doing? I get Claude to draw me a big chunky candlestick chart to look like real candles based on the open high low close data that I've already downloaded. And I can even tell it to go and get the data from, in fact, I can extract the data from TradingView if need be, if I want accurate data, or even from CTrader. Maybe there's a way to extract it from CTrader and get more data than I can get from TradingView. We'll see. But anyway, I'll base it on actual IC market data. So it reconstructs candles on screen somehow in a window that I can then paste into a document, or it can put it in a document. And what it does is it puts green and red dots inside, or numbers inside, like how many winners and losers inside each of those daily candles. Maybe it's like 2 wins, 2 losses, so maybe numbers in green and numbers in red for the wins and losses. That would be the way to do it. So each candlestick, and then inside the candlestick, if it's an up candle or a down candle, inside that candle will be 2 numbers, 1 in green, 1 in red, and they will represent the wins and losses inside that. And what will be interesting is to use that as a visual way of seeing, oh well, look, and I can overlay that to weeks as well. So the beauty with this is, which is what I've sort of done with the equity chart now, which is spreading it over weeks rather than just a straight curve. It shows me then where the flat periods are and when there's also a lack of trades going on. And then I can almost have this daily candlestick view on top of that for further highly visual way of seeing how this stuff plays out over time. And so when I've got my 300 trades over that 5-month period, or it's probably going to be more than 300, it could be 400 trades now, I think, but it will be whatever number of trades I've got from January 1st to the last day in May, that, well, it'll be the end of May now because it's the 29th today. No, 25th today. I don't know, but anyway, so it will be a very, very visual chart that represents, and for me, I think this is critical because it's so hard to look at an equity curve that goes flat on its own, but then you've got no sort of way of seeing what that looks like over time. And it's the time that's the biggest psychology thing, not just the, like, if you know wow, this traffic is bad. If you know that I know my trading routine, my system cycles in and out of flat periods and growth periods, and I can see a correlation, let's say between, well, maybe there's zero correlation between weekly and daily bars, right? I mean, this is the other thing. This is the other reason for doing this, is I've got this idea at the moment that it could be when prices reached a weekly level, and I say when the daily's reached a weekly, when prices reached a weekly level, the daily bars become more compressed and a bit more choppy as prices deciding WTF to do. Now, that's my hypothesis, and that will come out in the data I'm collecting. Now, the idea with this is if I've got a chart that's manufactured based on real open, high, low, close values for the daily, and I can overlay that on top of that, I can overlay my wins and losses. I can actually see, well, where is the choppy bit? Is it really when prices reached a weekly level? Or is it in fact nothing to do with that? So really with all of this, what I'm trying to do is to build a couple of things. Firstly, are there some very obvious, very simple, straightforward things that can improve the overall win rate? As in, am I missing in the raw data? Is there a level of direction that can be grabbed that might improve the win rate? I think they would be. Sometimes it's obvious and sometimes it's not, but that's why I'm grabbing the data. I think the second thing is, in this, and again, there's free text in the fields. Oh yeah, I mean, there's a couple of other bits I'll talk about in a moment, but the free text in the fields is collecting that. Then there's the whole thing around the entry, the rejection itself, and then the entry around that. So there's a whole thing around the analysis of fair value gaps or bags within that region. And something else which I've just considered, which I hadn't considered before, is And I need to loop this in as well. Drat it. Well, this is why I'm doing this open conversation, because I'd like to try and really lock these requirements down. So the other thing I've not thought about with regard to the rejection and the fair value gap analysis inside it is there also a fair value area? Because that's structurally part of what I'm looking at. Fair value areas are part of the structure. So if there's a fair value gap and a fair value area, then they need to log that as well. And does price reach the fair value area? So 100% has to be in there, and that can be relevant to that. That's easy enough to tag in. That's easy enough to tag in any of the entries. If there's a bag or a fair value gap, I simply I can say FEG or BAG plus FEA and then dash. I don't know, we'll see. But I'll add that in. And again, this transcript will be uploaded to Claude. We can pick through it, but very much at the rejection, we need to add in not just a fair value gap and bag analysis, but also a fair value area analysis as well, because actually that's the fair value area combined with a fair value gap or even a breakaway gap. That can be really powerful as a draw on liquidity to pull price back. So we need to include that. But, and like with the fair value gap analysis, it's on the entry time frame itself. So they may not be there, but track them if they are. And then if it retraces, then it's the retracement to the fair value area to fair value gap. So we're going to just need to think about that. It could be, if I say fair value area plus fair value gap and then retrace to fair value gap, you need to think about that. Maybe there's another code. Don't want it to be too complicated, but I still need to pull the data out. Again, 300 trades here. Once this is locked down and I start collecting the data, it'll become a really nice process to go through it all. Now, some of the other things I'm collecting, which may or may not be useful, I'm going to do this, which is MACD divergence. So I don't like indicators, but there's definitely something about when you get a divergence between MACD and price. If price is making a lower low and MACD makes a higher high, that's a divergence. And what I've seen is, I did one visual check on the first one I checked, and most recent price action, in fact, price on the resistance time frame, and this is very exact, I think it has to be the resistance time frame, is making a lower low, but MACD's making a higher low. And then the next thing with MACD, so there's the MACD and then there's a signal line crossover, and I credit this back to well, I don't credit it directly to this person, Gordon Phillips, but I'd watched his videos before 5 years ago and looked at this. His system was shit, his way of using it, but the logic behind the MACD is interesting, and the signal line particularly. So what I'm doing is logging at the time that the divergence occurs, and the divergence is including the signal line switch. Was the entry already triggered, or was it not triggered? And so this could be sometimes a leading indicator. Now, if it's 50-50, like sometimes it's triggered before, sometimes it's not triggered, then it tells me jack shit. And so if I get, say, 20 trades in collection, and so far the MACD thing is 50-50, I think I'll talk to Claude, but to me at that point I think it's statistically there's no value in just that 20 trades, and it's a coin flip, already a coin flip. It's not going to improve from there, in which case I'll just drop it and it's just one piece of data less that's not relevant. I'm actually right now 50-50 on whether it's relevant or not. I don't necessarily want to have an indicator give me a value or something. But and the reason I'm 50-50 is actually I can codify that quite easily. So I can have a little table, which I will get to eventually, a codification of the signals, which I'm discussing right now, as to what's present and what isn't present. It can all be built into a table. So I don't even have to I can look at the price action, but I can glance at a table which is dynamically updated, and it tells me all of these, what eventually I incorporate into rules that are valid. I can build it all in, and MACD can just be one of those, which is, if there's a light, there can be a little green light that lights up the, say, signal, a little green signal box or a button or like a round traffic light symbol, whatever it is, I can build all of that in. So that'd be quite interesting to do. So I think at this stage, probably I've highlighted a couple of bits which I've now realised I'm missing. And then so I'm trying to think now. I've picked up a couple of things here, hopefully recorded in this chat. It's 40 minutes long already, 41 minutes and 8 seconds, in fact. That I think are good to have. I definitely need that. I want to build out that candlestick view daily level of the wins and losses. I think that's going to be brilliant, and especially over the 5 months. I mean, that's like, well, 20 trading days a month. That's 100 trading days of data onto 100 candles, and then that'll be, you know, maybe like stick it all on a side of A4 in landscape format, and then just look at where it lies. It might be really visually useful to have that. And then the fair value gap bag inside rejections. I think the fair value area needs to be tracked in that as well. And then I'll keep thinking. I mean, hopefully Claude will listen to all of this, or it'll process it all, and it'll say, well, your thinking was along these lines. What about this? What about that? But it kind of needs to be structurally around the key concepts of fair value gaps, fair value areas, and swing highs and swing lows. So that's the whole thing about the analysis of the fair value gaps, and now fair value areas inside the rejection. It is structurally, using the same structural logic, what can it tell me? The rejection level itself is good because it's the sensitive part, but the you know, the rejection, the single first candle rejection, that's absolutely critical to not change that, just to leave it in place. I love talking to myself. Wow, that guy's an asshole. So yeah, I'm sort of thinking about, well, I can't think at the minute because I'm just watching these bloody cars. So it's about thinking of the sort of structural components. How else can I use, this is a good question, so how else can I use the three key structural components I've got in this analysis? So I'm using them at the top level gate, which is the bias and direction, as in what's in control and what's not in control. And why would I say that is, if I see that there's a fair value gap that now there's more candles coming into and clearly not respecting it, then I know that likelihood is that if it was a bullish fair value gap, that's probably not in control, and it could be now looking more of a lower move. And so now that could be it could be a range bias, possibly a bearish bias. It really depends on if it's a 4-hour thing that I'm seeing and the daily looks more in control, then that's great. But anyway, so that's how can I use those structural components? That's the thing. I'm using them at the gateway, the first top-down analysis, and then the PD array to PD array forecast. Then when it comes to the driving PD array, I'm using the same logic there. It's a swing high, swing low, fair value gap, fair value area plus fair value gap or whatever. I'm using the same logic there. The rejection is the same logic, but what I'm looking for, the rejection, is at that first candle in. So if there's a 1 hour fair value gap, that first candle into it on the 15 minutes, wherever it closes and wherever the high of that candle is more specifically, that is the sensitive spot. That's the bit then that I'm executing my trade off, full stop. So that bit is very specific, but it's still using the same structural ideas, which is, because it could be a fair value gap or fair value area, it really doesn't matter if they're overlapping, but that first candle, one time frame below the structure. And then from there, I'm dropping back in and looking again at the whole concept of on the entry time frame now, what the entry looks like. Are there fair value gaps and bags, and I don't look at on the high time frame, to be honest, with the structural stuff. I don't really tend to look at breakaway gaps, because invariably, if it is a breakaway gap, then it probably is sitting above a fair value area, and so I'll wait for price to come back to the fair value area, and therefore that fair value gap is part of the overall piece. It's just simply the first line of defence, and then the overlapping defence is the fair value area, even if there isn't a fair value gap there. But I'm explaining something here. It's impossible to do it well without a chart in front, so I'm not going to bother. The point is that at the top level, it's very clear. Bags don't really get considered in it because it's just part of the framework. Down at the rejection level, they become more important, because a bag is less likely to not only be a draw on price, but it's also less likely to hold price if price retraces to it. The idea is that the breakaway gap is one that, although it's a gap, actually we're not expecting a retracement, and if a retracement happens, then it's probably not going to hold. So that's why I want to collect the data on that at the rejection level. That would be really interesting to see it. And I think at that point, I just don't know if there's anything I can add to this. I think really I've discussed all of what I'm doing. I've dumped into thoughts all of the things I'm working through with Claude. I think the biggest thing here is to get the requirements absolutely nailed down, because if I rush into more data collection, I'm so eager to get the data. I just want to sit down and smash through it. And so today I'm gaming with friends, and I'm absolutely gutted, because I want a game, but I also want to do this. And this to me is like a game, but a serious game. I just love it like a game. I know it's not a game, but I love it. I just absolutely love this stuff, this data collection, the analysis, and then because it leads to being a trader. This is it. This is the outcome of this, is trading. Talking on that note, my idea is before I push the first button on take the next trade, I need to have collected all the data all the way through to whatever date I get to in real time. I think that might be by the end of next week. It could even be at the end of the first week in June. It's just got to be done properly. If I can get 50 trades a day, collected data with screenshots, then that's 50 trading days, and I think, no, hang on, 50 trades a day in, that could be 5 weeks at a time. So I think, let's say about a month a day. I've done January and February. I've probably got to go through that, and that'll be a little slower because I've got to clean the data up as I go. So let's say a day for each of those, even though I've got the data. So I've got January, February, March, April, May. That's five months. That's 5 days of data collection. So I've got 5 days of collection data time needed once I've baselined this data collection process. Now, what I need to do with Claude, and this is also going to be recorded as an outcome of this chat, is I need to have a quality assurance to start with, at least, well, all the way through. But what I want to be able to do is when I collect all the data from each trade, starting from trade 1, I paste it all into Claude, and it looks to the schema, and then it validates, does what I've entered make sense? Is it missing any schema specific things? And then secondly, does the text make sense for that schema? Can it understand it? And can it play back to me what it thinks it means? So I think that would be really useful. And maybe I'll just do that with every single trade, and maybe I'll get to 30 trades in, and clearly it's understanding it. And then all I can do then is to say, okay, well, just validate the schema and validate that you understand what it means, the text I'm using, and then we move on. I think that would be really, really good. Now, the other thing which I'm really wondering about now is, so all this data is in this big document, and I'm pasting it in one at a time and validating it like that. The next thing I'm wondering is, because that what that does is it sanitizes the document I'm working from to being 100% correct. Now, this is what I'm wondering about. Can Claude create me a database that has all of this in it, and also pulls the images in for each section? And then that database has a front end where I can click on the front end. It gives me a page of stats, as it gives me a page of the data, and then to the right of it, the view of the screenshots, and I can scroll through them. I reckon it can. I reckon there's no limit to what this thing can do. In time, I'll get good at asking it the right questions. So that could be really good. It could be that we do all this trade data collection, and I pump that into this database, and then run reports that way. And then maybe that database can then start giving me the graphic representations I want that I'm currently asking it to do ad hoc in a Word document. Maybe the database can do that. Maybe the front end of the database can do that. That could be quite interesting to do. And then I've got my own custom trade database based on this sort of raw data. Now, it won't be the same data identically that's in IC Markets, but maybe there's a way of importing IC Market data into this and customizing that. So maybe there's a grep or a command I can do. In fact, there will be with CTrader, an API call that pulls the data straight in. Wow. And then what that could be useful for then is pulling the data straight into my own database, and then I'm tagging it to my own tag codes. So I'm not tagging it using TradeZella, and then I can have a direct mark against what I have done correctly and what I haven't. So if there's a field I've missed, let's say once I've baselined the rules, no, just split this up. So let's do this. Wow, breakdown. So let's do this. Let's do this in 2 phases. This data is about getting the raw data together. So the outcome of this will be, hopefully, refined rules about what I'm doing. I'll have 300 trades of data to do it on. So I think that's a substantive set. And I think I'll have not only seen cycles of flatness or even loss and then profit, I will hope to have seen overall the trends for equity increasing over time. I'll have an understanding of what the drawdown periods look like, over how long they last visually, and then as in mapped against actual calendar weeks. I hit pause. I don't know if I hit pause. Fuck it if I did. Basically, I'm going to stop here. I think the next segment is get the testing done. Anything that transcribes to a clear rule that has an absolute, definite positive impact, as in it reduces losses and increases wins even if it's a loss initially and then there's a win following it, like a re-entry, brilliant. I'm going to keep all of that. And if it adds nothing substantively, then it doesn't get included.